My name is Eric Martineau. In part one, what I go over is how to use private equity banking. I go over the benefits of it, and there are 6 benefits to private equity banking. First, you get tax-free growth, both of money you put in there and the growth of your money. You get tax-free growth and use of your funds. Another benefit of private equity banking is that you get guaranteed returns with zero market risk. So you can think about that one for a second. The fact that, there is no risk with this and you get guaranteed returns. The next one, you get liquid cash whenever you want it. So unlike, say, a 401k or a government plan, you actually do get access to your money. No age restrictions, no funding caps. There's protections involved in private equity banking that you don't get anywhere else. So you get creditor and lawsuit protection as well as unpredictable economies because you get guarantees. And then you get compounded interest on everything you deposit into your private equity banking account, as well as getting compounded interest on all of your dividends. And then there's also arbitrage. And this is probably, for me, the most important part. You get to use your money twice. And I'll explain what that means in a second. But you get access to your funds. Your funds are always growing. And then you've got access to another set of funds that your funds are acting as collateral for that you can use and use your money twice instead of losing the opportunity cost when you spend cash. I also go over in part 2 some case studies on how this works. Both of these presentations are out on my website, and that website is right there at the bottom of this where it says privateequitybanking.com, and you can get out there and see that. Let me pop open the chat just in case any of you have any questions along the way. All right, and then another thing that I want to emphasize about what I believe private equity banking to be, I think it's kind of like the Swiss Army knife of the financial world, but I don't call it an investment. Some people do, I don't. And the reason I don't call it an investment is because for me, an investment is someplace where you stick your money and you put your money at risk. And as I said earlier, there are guarantees here. So here's some of the things that you can do with this Swiss Army knife of finances. Never go to zero paying cash. You can use your money twice simultaneously. And that's that arbitrage that I was talking about. And I'll explain that more in depth in a minute here. You can invest in real estate with higher rates of return and less risk. You can protect business assets from unpredictable events, real estate, equipment. So if you've got business owners that you're helping as a loan officer and they want to protect assets like their company's buildings or their equipment, there's ways of doing that here. And by the way, this can be used for yourselves or your clients. And again, that's why Mike asked me if I would do that because, and I'll talk more about it in a minute, but I believe using these tools helps us as loan officers go from being transactional to transformational with our clients. I'll show you how you can outperform the stock market with zero risk. Again, that's in my the other presentation I gave the other week. Invest in new business with higher rates of return and less risk. Show you how to build a predetermined tax-free retirement income and how to leave a predetermined tax-free legacy to your family. But the one we're going to do today is part 3, which is the benefits of private equity banking and how to use it to get out of debt. So I'm going to show you today how to get out of debt and stay out of debt. Arthur, thank you. When I get to this part about the debt action plan, that's where I'll ask you to help me out. So we're going to build a debt action plan with one of Arthur's clients. And if we need to make some fictitious information along the way, we'll do a little of that too, just as an example. Again, not trying to use anybody's real client there. Pay off structured loans with non-structured loans. We all understand the loans as loan officers that we use. We put people into mortgages, and obviously they have to pay those on the 15th or the first of each month. And non-structured loans being loans where you don't have a payment schedule. And then how to get out of debt and simultaneously build generational wealth. So once we've helped a client get completely out of debt, then we can help them build generational wealth. Now, if you're dealing with people that are already wealthy, we can just go into the building generational wealth part. So who can use this get out of debt thing? Well, obviously W-2 employees that we seem to deal with that are up to their eyeballs in debt. What I call our S-Corp professionals. Now, that doesn't mean that they're really all working for an S-Corp, but a lot of doctors, lawyers, and engineers. I mean, doctors come out of school with $250,000 in debt. We know this. This is a great place, even though they've got very good incomes to help them get out of debt and then grow their wealth from there. As I mentioned a minute ago, business owners, key person, cash flow. So you've got cyclical clients that make a whole lot of money in the summer, like a solar company, and then in the winter they can't afford to get rid of their electricians, so they need to flatten out their cash flow. We can help your clients with that kind of stuff. And then obviously high net worth investors to build generational wealth. Now that COVID is over with, America is at the highest amount of debt, consumer debt it's ever been at in history. 1.7 trillion in student loans, 1.5 trillion in auto loans, 1.2 trillion in credit card debt, and mortgages currently are at $12 trillion. The question I ask to begin this is, if I could show you how to eliminate all your debt in 6 to 9 years without spending any more, would that help? And how could it help a loan officer? Not just your own getting yourself out of debt, but your clients. And that's what we'll talk through today. Now, I want to set a foundation here for terms. And again, I understand the crowd that I'm chatting with here. We're all loan officers. But I want to talk about the functions of money. And that may sound crazy, but like I said, in my mind, and this is just me, I think there are three general functions of money. There's the banking function. In other words, where we warehouse our money and where we borrow our money. And when I'm warehousing, borrow my money, I want it to be safe. I don't want there to be any risk. I want it to be no taxes, anytime access, and guaranteed growth. Then the second part is investing. And the third one is spending. And I divide out those other two. So when I'm warehousing my money, as I said in the beginning, I don't consider this an investment because it's just a warehouse. Yet I can move that money out of the warehouse into an investment, or I can move it out of my warehouse and I can spend it. And in either case, because what we're doing right now allows us arbitrage, the money in our warehouse is never depleted. It's never even used. It's never even touched. Once you put your money into this warehouse, you never have to pull it out again. And then when you do pull out monies, you're borrowing against what's sitting here and you're putting it into investments or you're spending it. You're not losing the opportunity cost. There's a book out there by this guy by the name of Barry Dyke, and he says this: money, obviously we know this, money must reside somewhere, right? But when viewed in this light of all alternatives, permanent cash value life insurance is perhaps the safest and most economically efficient holding tank of cash savings within America today. I know some of you are going, wait a minute here, we're going to talk insurance? No, we're going to talk savings accounts. But let me ask you this. How many of you have ever even thought of using an insurance company as your bank instead of a typical bank? Okay, Ryan? Anybody else? What benefits are there to that? Let's see. Somebody raised their hand.
Eric, I've been using this strategy for myself for about 10 years now.
Oh, you've been using this for yourself already?
Yeah, for about 10 years now. I've used the cash out of the permanent life insurance. I use the cash out to buy real estate. So I use the ghosting of it. I'm still breaking money. Yeah.
So we've got here somebody.
I got really excited. I just got really excited when I saw this slide.
Okay, so we've got somebody here that's actually doing it. I love it. So please feel free to chime in. And anybody, please ask me questions along the way. That's what this is about. Now, comparing a bank, a traditional bank, to an insurance company. Janet Yellen, the head of the Fed, said, "I don't believe we'll see another financial crisis in our lifetime." And she said that back in 2017. You think she's right? Ryan's shaking his head. No, of course not. Okay. Now, this is not a condescending question, but literally, what did you have to do during the Great Depression to get your money out of a bank?
You actually had to go into the bank.
There you go. Thank you, Kenny. I know. So obvious. Now, March 9th of this year, Silicon Valley Bank. Do any of you know what happened really that day when these guys went down? Their VC, they work with a lot of VC, venture capitalists in the San Jose area. And so one of the VC that works with Silicon Valley Bank told one of their companies that they had invested in that they were kind of getting skittish on Silicon Valley Bank, and they told them to pull their money out or suggested that they might. This gossip or news spread like wildfire through Twitter and WhatsApp. In fact, on Thursday, March 8th, there was a total of only 8 tweets on Twitter about Silicon Valley Bank that had that word in it. Do you know how many tweets were on that happened on Friday, March 9th? Anybody want to guess?
2 million.
Over 8 million tweets on Friday. And so what happened is customers withdrew $42 billion, 1/5 of SVB's deposits in just a few hours. Are we living in the same world? Our grandparents' world? No, obviously not. And so in my other presentation, I go a little bit deeper into the difference between a bank and an insurance company when you're using an insurance company as a bank. But I just want to focus on 2 of them here. And the answer's already written out. But when Nexa deposits your commissions, Wells Fargo, Chase, your local credit union, who owns that money? Who has complete control of that money?
The bank.
The bank does. And that has been shown time and time again through courts. Okay? When you put your money into a mutual company, and there are stock companies, obviously, in the insurance world that this would not be true for, so I want to make sure that I'm clarifying this. But if you put your money into a mutual company as an insurance company, who owns that money?
You do.
We do. Huge difference. And here's why. The fiduciary responsibility of the executives at a bank is to make money for whom? And again, not a trick question, just making sure, driving home the point.
Shareholders.
The shareholders, exactly. And at a mutual company, who the fiduciary responsibility of the owners is to whom here? Because there are no stockholders. There are only
Policyholders.
And so I have a policy at one of these large mutual companies, right? And therefore I am a co-owner. And the owners act for and on behalf of my best interest, not the stockholders' best interest, i.e. a lot less risky. Again, I go more in depth in that in a different presentation, but I wanted to drive that home. So from a warehousing and a borrowing standpoint, these companies have some of the lowest risk out there. Now, here's another one I wanted to talk about. Again, there's a lot of different differences, but on the borrowing side, when you've paid off a loan, how much money is in your bank account? You've gone back to zero. Whereas here, as I stated, when you borrow money in a private equity banking environment, what you're really doing is using your private equity banking account as collateral to get at funds that the insurance company loans to you. So you get a separate account lent to you than the one that you have. So what happens with your account from an interest standpoint? It continues to grow. Exactly. Whereas the debt that you're borrowing, you can pay against that and you pay it off, and that one continues to shrink. So you're paying less and less interest. So you've got an arbitrage ability here that you don't have anywhere else. Ryan just told us he uses that to buy real estate, correct? Do you use that to do fix and flips or long term?
I do more for cash flow, but the way it works, for those of you guys that don't know, and I always call it actually even insuring my already insured money, because with a permanent life insurance, you have a death benefit and you have a cash value that grows. So every time I pay my premium, the cash value is growing. So that's just for example purpose. So you have 100,000 in there. My policy allows me to take out 90% of it. So on 100,000, I can take out 90,000, and I can use it to buy real estate. And what happens though is that I'm still earning my return on that 100,000 as if the money's in there, even though I've already taken out 90,000 and bought real estate with it.
Exactly.
Now, what happens?
So you're using your money twice. In other words, arbitrage.
Right. And if I already get smacked by a bus tomorrow, the mortgages that I have on these properties aren't going to be debt to my family. They're just going to deduct from the death benefit, and they get paid out for it. So it's
exactly. Thank you, Ryan.
You know what, Eric? It's funny. I've been doing this about 10 years. I didn't know anyone else was doing this, and I always it was amazing. Okay.
Yeah. You see, you just hit on something there. When I sat down with Mike after this was all over with, and I was interviewing him, you can find the video out there online. Mike Cordes said to me, you know, Eric, when I heard about this, I kind of felt ashamed that I had never heard of it. You know, because he's been involved in, he's got millions now, and he's been approached by a bazillion people about all kinds of things. And he was like, I kind of felt embarrassed that I hadn't heard of this. And that's the thing. They call this program, the New York Times called it the secret of the ultra wealthy. And so it is. Very few people understand it. But okay, so to keep going, let me ask this question. And you just touched on this, Ryan, because you said it's kind of ensuring your already insurable, interest there. But how much of your financial security depends on people, companies, and economic situations you can neither predict nor control? And, for most of us, it's 100%. For Ryan, it isn't, because at least his real estate is predicted in something that he can, predict and control. Anyhow, again, I don't know what the right answer is for each one of our personal portfolios, but I would suggest that some of it needs to be protected. Okay, back to the task at hand, which is to show us how to get out of debt. This came out when I was just after I got out of high school on the far side, where he said that the library in hell is filled with mass story problems. So here's your mass story problem, loan officers. If your money's earning 4%, does it make sense to borrow at 6%? What do you
No.
think, Ken? Okay. So Kenny says no. Any other answers? James, what do you think? If your money's earning 4%, does it make sense to borrow at 6?
Yes, it does.
Yes, it does. Okay. We got one yes, one no. Anybody else? Arthur's just smiling. All right, let
Yes,
me go
'cause-
through this. So here's the typical. Let's go through the two typical ways that we buy that we acquire things. We got a car that costs $30,000. We can pay cash, right? Or we can borrow $30,000. Let's say in this example at 6% over 5 years. Okay? So the way that we were taught are just these two ways. And the first way, when we spend our $30,000, what happens to the opportunity cost with that $30,000? It's gone. That's correct. Okay? So we go to 0. All right? The second way is to with this opportunity cost, let me ask this question, and I don't mean it to sound condescending, but in 5 years, if I spent cash to buy that car for $30,000, how much has my $30,000 grown during those 5 years? Virginia's shaking her head. Nothing. Right?
It's not negative.
It hasn't grown at all because I spent it. My opportunity cost disappeared 5 years ago in the rearview mirror. Okay? Again, I don't want to sound condescending to anybody in this group because obviously we understand these things. The other one, let's say we borrow $30,000. So we leave our $30,000 sitting in the bank, and fictitiously I'm saying at 4%, and we're borrowing at 6%. So in year one, our savings account grew from $30,000 to $31,200. We all understand that how that works as loan officers. And we borrowed $30,000, and we're paying it back as though it was a structured loan on a monthly basis. So at the end of the year, we've now paid that debt down to $24,695. Everybody with me on that? Okay. The second year, our savings account has now grown to $32,448, and the loan we took out has dropped to $19,000. The money we left in the account is now grown in year 3 to $33,745, and the amount we borrowed is now down to $13,086. Year 4, $35,095 is our savings account, and we've paid this down to just $6,738. And in the last year, our money has grown to $36,499, and we've paid off the loan that we borrowed at 6%. It's now at 0. When we look at the difference there, the net gain, $1,700. So who was right, Kenny? You or James?
What's the net pay? You're saying paid $4,800 in interest?
Yeah, in interest. Yeah, thank you. I should have clarified that. Yeah. So it cost you $4,800 to borrow that money at 6%, but you were paid $6,499. The difference, $1,700. Thus showing that it does make sense to keep your money there and keep it growing. Okay, so let's toss that next step in, which is arbitrage. So we talked about the saver way of doing it. We've talked about the debt way of doing it. Now let's throw in the insurance way of doing it. And what ends up happening here is you do have to act like a saver for the first, say, however long to get to the $30,000 example. So let's say each of those, it took 5 years to save my $30,000. But now, instead of wiping out my account and getting rid of my opportunity cost, I go buy that car or truck or whatever I was buying with a loan from the insurance company, and I pay that back. But I never went to 0 with my cash. And so my cash will grow over that 5 years. And then I do it again for the next vehicle and then the next. Does that make sense how that works? Okay. Mm-hmm. So again, this is, as I stated, these are IRS sanctioned accounts. What the IRS calls it, I call it private equity banking because it just sounded better. But the IRS calls them cash value accumulation contracts. Really, I probably could have bought that domain too, but it was so long it didn't make sense, right? So private equity banking sounds a heck of a lot better than cash value accumulation contracts. But if you look it up in the IRS code, that's what they call it. The key word there is contract, right? So again, another question. How much of your financial security comes with guarantees? you got it sitting in the market, is it guaranteed? If you got it sitting in a bank, is it guaranteed? Yeah.
Only to a certain amount.
Yeah. And even then, we're the last creditor of importance according to the banks, according to the court cases. So, okay. So now here's what I want to do. I want to make a customized turnkey debt elimination system based on proprietary software with written guarantees. Arthur, this is about where I'm going to jump in and ask you to help. So why focus on debt first? Us as loan officers understand this in spades. The average American household spending for every $1,000 that we earn is 40% on taxes, so $400 of every $1,000. $230 goes toward lifestyle of every $1,000. We pay debts as Americans about 34%. So of every $1,000 that I earn, I'm spending about $340 on debt service, and then only 3% goes towards savings and investing. And by the way, doesn't matter if you're a doctor or a school teacher making $15,000 a month or $5,000 a month. The ratios are about the same across the board in America. I know you're going, wait a minute, all my clients have 49% debt, Eric. But, that's just where the averages come out. So if you were to talk to a financial advisor, where do most of them focus your time and energy? What do they want you to do? They want you to save just a little bit more, right? And so what we focus on is real leverage. If I got a 10% return on that $30 for every $1,000 I put out there, I just made $3. But if I can eliminate 1% of my debt, I just made $3 or put $3.40 back in my pocket. Right? Does that make sense? Okay. Let's say I got a phenomenal return of 20%. Okay. Now I get a whopping $6, right? Warren Buffett was asked once on CNBC Money, that he's told the story of a friend of his that ran into some money, and she came to him and said, "Hey, Warren, where should I invest this money?" And what was his first question to her? "Well, do you have any debt, credit card debt?" And she said, "Yeah." And he said, "How much are you paying?" She said, 18%. And so he said to her, if I owed any money at 18%, the first thing I'd do with that money is I would pay it off. Then he told her, it's going to be way better than any investment I've got. By paying off the balance, she would save more money on interest than any return she would get by investing the money, whether in the stock market or real estate. And this is what Buffett told her. I don't even know where I can make 18%. I'm sure he's found investments that have made a heck of a lot more than 18%. But I think what he's saying there is on an annual basis that he knew guaranteed he'd make 18%. Paying off a loan is a guaranteed get out of debt at 18%, right? So again, if I can help people get 10% of their debt gone, that's a $34 back in their pocket. And if I can help them get 50% of their debt, now they got $170 back in their pocket without having to earn any more money. So the average family in America makes about $87,600. 34% of that means about $29,873, almost $30,000. So let me ask this. How would $30,000 in extra annual liquidity help the average American family? Let me ask you loan officers. If the people you're working with had an extra $30,000 available to them and no more consumer debt, you think you could help qualify more people for loans?
Absolutely.
Absolutely. And that's why Mike Cordes asked me to do this, so that you could help be that person for your borrowers. As Mike said, although debt elimination isn't our job, what it does is it takes our job, which is, and we like to pretend that our clients are always going to remember us and they're always going to come back 6 to 7 years later when they refinance or whatever. But it takes us from being a transactional person in their lives to a transformational person in their lives. If you've helped one of your clients get out of debt in 6 years or 9 years, do you think they're going to come back to you when they do decide to go get a different property? Yeah, Virginia's shaking her head. Yes, exactly. And that's the point. So if it didn't make sense, that's why we're trying to do this. Okay, I am now ready, Arthur, for you. So let me go in here. This is some software that I've got. Create a new case. And it's always scary when you do stuff live. But Arthur, I'm just going to name this Arthur Test. Are you okay with that?
I'm cool with that.
Okay. And what's your email address? I'll just put down you. Okay. Case title, and we'll call this And this would be whole life. All right, let's save that bad boy. Okay, so what I do, this is the process that I would run through with your clients, and I just want you to see how this would work. Okay, so the first thing to do is to create a new scenario with my software. And the first one we're going to do is the mortgage. So, Arthur, does your client have a mortgage?
No, not currently. They're first-time home buyers.
Okay, well, I'm going to claim they have one. How's that? Like I said, we'll
Sure,
do
let's
some
do
of this
that.
fictitiously. Okay, so we'll call this the primary because I want to show you how fast they can get rid of all this stuff. Okay, about how big of a home are they looking to buy right now, these first-time home buyers?
462.
462. Okay. And what kind of an interest rate are you going to be able to get them right now?
5.5.
Okay, so you're going to put some money down toward that. Okay, now this tells me that their payment is going to be a minimum of $2,623. That's the principal and interest. I know you're going to have taxes and insurance someplace else. And do you think these folks are going to make that minimum payment, or are they going to try to pay it off a little early?
Minimum payment.
Okay, so I will leave that at 0. Now, if I put in there that they're making payments of $3,000, it's going to figure out that there's basically an extra $375. What I promise people is that I'm going to help them get out of debt without having to get them to spend more than they're currently spending. Okay, so
It's a VA purchase. Our pay.
okay, so it's fixed and it's their primary home. All right, we'll go on to the next one. Now, if any of you are doing this and I had another one, I could add another mortgage. So say this is one of your investor friends that's got 2 or 3 mortgages like Ryan. I could add more mortgages there. Okay, consumer debt. Let's walk through some of this. How about credit cards, Arthur? Do they have credit cards?
Yeah, they have quite a few.
Okay, let's just call this credit card 1. And how it's a revolving debt. And what's the principal on that one?
886.
Okay. And what is the interest rate on that one?
Ooh, I'm not sure.
Okay, let's
Does
just
it
call
say
it
it on
18%.
Okay.
Oh, it was 800. You said 860, right?
886.
Oh, 886. It put an extra 0 there. Sorry. 886. Okay. And so the minimum payment on that is $22. So let's just put 23 there. And what do you think their actual payment is on that?
$56.
$56. Okay. Now watch what happens here. See how it's telling me now that I've got an extra $33 here in redirected cash? What we're going to do is help your clients take inefficient dollars that they're currently paying to wipe out their debts faster. All right. So let's go with the second one. And we'll just call this one credit card 2. Uh-huh.
The balance is $14,089.
$14.89. Okay. And the minimum on that, well, what's the interest rate? Any idea?
Maybe 17.
17. Okay. So the minimum payment on that is $340. And how much do you think they pay on that one a month?
The minimum payment.
Okay. $340. Next card? Or what
Next
debt is?
Yep, it's a credit card. The balance is $2,325.
$2,325. Sorry for the monotony here, folks, but you'll really see how this can do what it's supposed to do. Okay, interest rate?
15%.
15. Okay. And so the minimum payment on that is $53. And how much do they actually pay on that one?
$60.
Okay. $60. All right. Oh, it's asking for an actual, so I'm going to go for 45. See if that'll clear that error up. Okay, no, it's saying I have to pay $341. Has to be greater than. Okay, next.
Next one is for another credit card, $1,953.
$1,953. Okay, interest rate?
7. And they pay about 62.
Okay. This is cool. You've got actual numbers on this. This is going to be fabulous. Okay. Credit card 6?
Is for a balance of $928.
Okay. Okay. CC6. I better go call that. Okay. And then credit card 7?
A balance of $924.
Any more?
Yes, there's 2 more.
Okay. Sorry, folks.
The next one is for $518.
See what I get for asking for a volunteer? 500 what?
518. All right,
All right.
the last one is for a balance of $408.
Okay. Credit card 10. Okay.
$408 balance.
Okay. Interest rate?
And let's say 20.
20. Okay. Minimum payment is $11. And how much do you think they pay on it?
They pay 70.
70. Okay. How about regular debt like for cars? So instead of revolving debt, but
Yeah, they have one installment loan.
okay, one installment loan. Is it a car?
Yeah, it's a car.
Car 1. Okay. How much do they owe?
They owe $12,990.
12,990. Okay. Interest rate on that loan?
8%.
8. Okay. You know what their payment is on that one?
43.
What's that?
343.
343. And what do they actually pay? Same?
Same, 343. Yeah.
343. Okay. All right. Any other installment student loans, anything like that?
They have a bunch of student loans, but yep, they're all indifferent currently. You still want to?
Yeah, I would for sake of this. If this doesn't just keep going on for everybody out there, why don't we just add one in there for their total student debt? Okay.
Okay, so approximate. All right, let's see.
Yeah, student debt. Normally, I would go through each of these, but I don't need to make each one of you watch this because this is getting tedious. Sorry.
I would say at least 20,000.
Okay. And we'll leave the interest rate at 0 for now. I'm going to call that, though, a revolving debt just for a second so I see how much. So about 200 would be the minimum. So I'll call that 200. And right now they're not paying anything on it, but let's just call that again the 200.
Yeah, that's actually about right. They have a deferred plan. It's about 200 when they start paying.
Okay, and that'll be at about 6 when they're finally finished. Okay. So now let's go over here to investments. Do they have qualified plans, 401k?
No, they don't.
Okay. Any other investments, savings accounts?
Yeah, they have about 40,000 in a checking account.
Okay, so savings. Okay, and we'll call that savings. And how much do they contribute that on a monthly basis?
Let's just say like 150.
Okay. 150. All right. Any other investments?
No, that'd be it.
Okay. Income sources. Let's go over here. And person one?
Person one makes 6,200 per month.
6,200. Okay. Salary and wages. Okay. Is there a second?
No, just one income.
Just one income. Okay. So let me get rid of that. All right. Now, what I've done, by the way, well, let's go to insurance policies. Do they have any insurance policies that you know of? And those aren't questions that you would have asked, so I don't expect you to have a yes or no there.
Just I heard them talk about renters and auto.
Okay, so they probably don't. All right. So what I'm going to come back here and do, because I created a policy, I created a fictitious example, depending on how much money we got to up here. So I'm going to say that they're going to throw in another $90 from their income to take my total up to 500. Fair enough? For everybody here, just for the example, because I had to create a scenario, and so I made some at 500, 1,000, 1,500, 2,000, 3,000, 5,000, etc., so that whoever was my guinea pig, thank you, Arthur, I could then just pull up an example and show you guys this. Okay. So since I don't have any of that, let me go into the report, and I'm going to pull up a new report, and I'm going to example of 500 monthly. You guys okay with that? This is a 40-year-old. Obviously, I would probably have them supercharge this sucker by putting a portion of that in, but I didn't build that scenario, so we'll just forget about that. One of the things I'm going to put in here is an emergency fund. So I'm going to say that they always want to have at least 500 available in case something happens. And then note down here, Avalanche is the highest percentage down. Snowball is the smallest amount, and then I go to the largest amount. So I'll just leave it on Snowball for the sake of this. I come over here and I generate a report. Again, what I did here in a fictitious way is before I started this, I said this person is 40 years old. How old's your client anyhow, Arthur?
They were born in 95. So
Okay, so they're not even 40 yet. So this would be an older person than this person. Okay, so let's download the report, and I'll show you what I'm able to then show a client. So I end up getting a report like this that I can then show your clients. And the first step then is in your current plan. I show you your current plan versus the new plan. You'll need 4 things to be successful: a little bit of money. So with all this debt, 6,000, you see how all I've done is redirect $500. I know I added an extra 90 there, but let's just assume that they're willing to do that. A little bit of discipline, a little bit of trust. So strategy 1, identify inefficient payments. So what we've done is we found out that they're overpaying on some of their cards, and so that's the inefficient money that we're going to put into this insurance policy. Then they're going to make minimum payments on all of their cards instead of overpaying while shoving that money into this insurance policy. They're going to build up cash value, and then they're going to use that to take out policy loans to pay off their credit cards and all that other, their cars and things like that. Okay, so their current situation, this person is going to be in debt for 30 years and 1 month. Current balance in debts is $519,000. They have minimum payments of $3,734 a month. And then they've got, they're going to be in debt for 30 years. Does that sound about right? Everybody tracking there? So I would show them where they're currently at and how much of this is going to be interest. A lot of people don't think about this, but really over the next 30 years, this couple is, or this guy or gal is going to pay almost $500,000 in interest. Pay more interest than the principal they own, right? So if we run this through this plan, this is what it would look like, and this is when we'd start paying things off. Notice here, this first debt, they're going to pay that off in November. Does that give you an excuse to call your clients?
Mhm.
Hey, congratulations, Arthur Test. Time to pay off that first credit card. Bam. You help them through that. They pay off that card. Then the next one's going to go away in December, a month later. Hey, you ready to pay off that second card? Boom. They pay off that one. Then 8 months later, they're paying off that next one. See how now you have an excuse to stay in their lives and stay active with them? And look how long it's going to take to pay off all of those credit cards. 2 years. Loan officers, hang with me. What has just happened in 2 years? What's their credit score right now, Arthur?
652.
652. In 2 years, if Arthur can get this person to pay off all their debts in 2 years, all that credit card debt's gone. All they have is the car and the home left. Where's their credit card? Where's their credit score at? Think it's still at 650?
No, it's probably high 7.
Probably high 7s. Exactly. Arthur, what could you do at that point with this client?
A lot.
Yeah. How about, if nothing else, could you refi this home into a lower interest rate and make it a 28-year mortgage instead of a 30? Just so you don't start that interest rate clock again? Yeah, you could. And you'd probably be able to lower their payment, right? Maybe make it a 25-year at a lower interest rate and keep the payment the same. You guys all understand that. But again, since it seems paradoxical that here we are, loan officers, getting people into debt, and here I am teaching you how to get your clients out of debt, right? But there's so much that we can do for our our clients if we do this. So let's keep rolling down here. We pay off credit card number 2 in 3 years and 4 months. We pay off the student debt in 4 years and 3 months, and we pay off the primary home in 18 years instead of 30 years. Without spending any more money than they were currently spending or saving or earning. And your client's kind of young. You think that this person will start making more money at some point in the future?
Yeah, definitely when their spouse starts working too.
Okay, so there you go. But this is what happens. And here's what we were talking about, generating wealth. So after the first 20 years, they have total assets of $97,000. But after 30 years, $633,000. And at 40 years, $1.2 million. And this is the kind of a report that I'm able to give all of your clients. And as I said, I think these dates are the most important thing to us as a loan officer, because it gives us the ability, gives Arthur the ability to continue getting back in their life, right? And obviously, you're going to call when it's time to pay off card number 1, and it's Christmas time. And what are they going to tell you? Hey, Arthur, I'm sorry. I put some money back on card number 2. All right, cool. We're human. But they understand the principles here, and you're giving them a tool to get and do this the right way. Okay, so one more thing I want to show you, and then I'll just turn this over to you guys. So you notice that we have all this stuff here. I'm able to start walking this person through it. And I think the first one got paid off, watch this, at month 4. So in month 3, come on, let's go back here. They have cash value of $891. And then in month 4, they have cash value of $1,189. As I was saying, it never shrunk. But they borrowed to pay off that first credit card. Now they take that money that they were paying toward the first credit card and lump it into paying off the next one. So now in month 5, your client there, Arthur, pays off their second credit card. And then in month 6, nothing, 7, 8. So in month 8, they pay off the third credit card. You see how this is working? And this cash value just never shrinks. It just continues to grow. Whereas this debt part goes up and down, allowing your client to pay this off. So as we move this out over the years, in year 7 or 8, where did we lose all the credit card debt? Let's go back there again. I pointed that out a minute ago. But if this person stops here at, if we get them out to year 4 and they've paid off all their credit card debts, we as loan officers know exactly what just happened to their credit, right? It's gone through the roof. It's a lot better than where it was. They have a lot more options. They might want a different home. They might want to refinance the one they've got. Anyhow, that's kind of what I wanted to show you folks today. Getting them completely out of debt is now at 18 years. Took a little bit longer because we were only throwing in 500. I guarantee you that if I had uploaded a scenario throwing in 1,000, this would have been done a whole lot faster. So, Arthur, if there is a spouse there who's still in college and about ready to quit and get out into the workforce, and then they could throw in 1,000, again, we could create something like that that would help them, which is what I just did for that young couple I was talking about. We know that the wife, her income's going to go from 40 to probably well over 100,000, whereas the husband's going to stay in the military, and so he's going to keep making about 43. So we've built it knowing that within 6 months, this gal's going to be able to start paying a whole lot more in. All right. I'll stop the share at that. Well, any questions, folks? Let me just open it up. I know I've run over. I apologize.
Yeah, I have a question. Yes, and if I understand correctly what you're saying, which I think I do, what you're talking about is leveraging the power of permanent life insurance for the cash value to basically take the cash, have them paying minimum payments, and then redirecting the other cash to pay for the policy to accumulate the cash value that they're then going to loan out against the policy to pay down these debts faster. Is that fair?
Exactly. In fact, Valerie, can I use one of your clients as an example, Valerie?
No, this is perfect. Eric,
no,
is there anything?
I'm asking Valerie, Ryan. She's on the call. So can I show them something that we did with your young, without giving his name? This one here?
Yeah, you sure can.
Okay. So this gentleman here, young man, 26 years old, just got a raise. He was all excited. And when Valerie and I started working with this gentleman, he was very skeptical and probably wasn't going to put in more than a couple $100 or $100, right? But when we ran what he could do, he was like, oh, well, can I put in 500 a month? And so I went back and ran another scenario and said, okay, now it's 500. And then we showed him how quickly he could get out of debt and what he could do with this. Really, he wants to buy a car when he's got $30,000. And he said, well, what's the max I could put in? So went back to the insurance company, and it had to do with his age, and it came back at $520. And he goes, okay, that's what I want to put in. So if you did the math on 6,240, that's putting in 520 a month. But then he now decides to divulge to Valerie and I that he's got another 5,000 sitting there in savings that he didn't talk to us about the first time. And so this is what his policy actually ended up looking like. So again, as people begin to see the math, it could go from, like the client, Arthur, that we just did for you, where I promised
we don't see your screen.
What's that?
We don't see your screen. We don't see your screen.
Sorry. Thank you, Valerie.
Yeah.
Okay, so this is what Valerie and I came back and showed this young man, was that if he put in 100 and something bucks, what his cash value would be. And that's when he said, well, can we move this up to 500? So then we moved it to 500, showed it to him again, and he said, okay, well, what's the max I can put in? We went back to the insurance company, and they said, due to his age, the most he can get in death benefit is this. Which brings up another question. Folks, how many times have I talked about death benefit in the last hour and 15 minutes?
You haven't talked about it at all, which I think is actually a huge selling point.
Exactly, because I'm not selling death benefit. And after this presentation, I always get somebody to send me an email and tell me, okay, Eric, I'm willing to put in this much a month, this much a month. How big of a death benefit can I get? And what's my answer? I don't help you get death benefit. I help you get a bank. Now, for this young man, it turns out that he's got almost, $476,000 in death benefit. But the reality is we're talking about using this as a banking vehicle, not necessarily a death benefit. That comes in way down the line when you're getting closer to that point in life, and then you're borrowing back. Yeah. Sorry, Ryan, I interrupted you. Did that kind of answer your question, or what else could I answer for you?
No, this is perfect, because again, I've actually been talking about people. I just can't. I'm like kind of speechless. I'm so happy right now because I've been talking about this for like 10 years, and to hear next to teaching this is just awesome for me. Yeah. But one of the things I was going to tell you that whenever I talk to somebody about this stuff, because when they're trying to get out of debt, if I don't talk to them about how to leverage it and think about it like a bank, like you just said, all they see is another bill, right? They have to pay the premium. So the way I always talk about it is, hey, the concept of ghosting, I really hone in on that, which is to your point where they can actually take the money out, use it, and they're still earning the interest as if the money's still there. So I hammer that hard. Right. And then I talk about the extra insurance of the death benefit. I'm like, listen, you don't want the death benefit because that's bad. If your family gets something, that's bad for you. But if something were to happen, your family's not stuck paying back this money taken out of the policy. They just deduct it straight off the death benefit and they get the rest. So you can either pay it back, or if you can't pay it back, it doesn't matter. You don't actually have to pay it back. Like, I personally never paid back a penny of the money I borrowed out of my policy, ever. Because for me, at the end of the day, when my time comes, they're just going to deduct off my death benefit, and that's fine because I'm using it as a bank, not as as a death benefit.
Exactly. And same with mine. My wife and I use 60,000 of mine. I've almost got 200,000 now in my account. And
Right.
we use 60,000 of it to put as a down payment for this home. In fact, folks, this
And
I'm
you
not
can keep
kidding about
borrowing.
this either.
You can keep borrowing as much as you want.
Yesterday
Yeah.
we're sitting in our front yard working on an RV because we're about ready to head on vacation, and our neighbors had a yard sale. And so, we wave at them and they're selling all their stuff and they got their kids out there doing stuff. And anyhow, I heard somebody that came over ask him, if he was in the military, which was obvious. He is. We live in a military town. And they started talking. The guy said, yeah, I'm about ready to retire. My wife and I are just going to buy an RV and we're going to take off in an RV. And we're putting our house up for sale on Monday. My daughter and son-in-law live in this area. And so we were like, oh, we'd love to get that house, right? So I walked over and I said, you got a VA assumable loan. What's the interest rate? And they told me 3.65. I was like, that's good, especially in today's, right? And I said, what's the mortgage? And they told me, and I was like doing the math in my head at 3.65. That's something that I think my daughter and son-in-law could afford. And I said, so how much do you guys want for the house? And they told me that they wanted what would come out to about $25,000 extra over what they owe. So I walked back to my wife and said, hey, honey, how about we pull $25,000 out of our account? We pay the difference and we help the kids qualify for this VA assumable loan. So what do you think the very first call we made today was? To that guy's bank. And so, it's not our house yet, but that's what you're able to do when you've got money sitting in an account like that, is that Diane and I have enough money to just pull out and pay the difference between that mortgage and allow our daughter and son-in-law to move into the house next door to us, which will be a real benefit to them because he's about to deploy in 2 months and go overseas for a year. And so we got two little grandkids there, and we'll be able to help. But again, the story isn't about my kids and how we can help them. The fact is that we've got money sitting there that we can go borrow against immediately to purchase a house that will help our daughter and son-in-law. Anyhow, any other questions?
I have a quick question,
Yes.
Eric. So if my clients were to do something like this, what would be their upfront cost?
Nothing.
Nothing.
No.
Okay.
That's
They would
why-
just make payments into the account until
Yeah.
there's enough money to pull out from it.
Let me go show you here. So, Arthur, what I did beforehand was I created this. So it says example 500 monthly. So this is what that
I
policy
see.
would look like. It's drafted on an annual basis. I mean, it's not drafted on an annual basis. It's drafted on a monthly basis. So your client, all you're going to ask them to do in this case is to quit putting $500 toward inefficient overpayments on their credit cards and put $500 into a policy. And at that age,
okay.
$500 a month, and again, the word we've not talked about this entire time, is a death benefit of about $100,000 is all.
Mm-hmm.
Because really what we're talking about is
Gotcha,
creating
okay.
them a bank account.
Oh, okay. Oh, wow.
So if they did this
Interesting.
for
All right, cool. Yeah, that makes a lot of
age
sense.
40
Okay, get
to
it.
age 60, they've got $160,000 now in savings, only putting in $500 a month, and they got completely out of debt. When was it? At year 14? Completely out of debt, including
Something
the
like
mortgage.
that.
Yeah. So, bingo. That's all they got to do is just redirect $500 from where it was at to this.
Right. Wow, that's so cool.
Yeah.
And then the money that you take out, do you just make the minimum payments to the policy, or?
Yep. Yeah.
Right.
So if you pay off a credit card in
Yep.
their case where they're paying $40 a month, now you take that extra $40 and you pay back the loan that you borrowed from the insurance company, so you can have that paid off. And then as soon as you pay that off and have enough in there to pay off the next credit card, you pay off the next one, then the next one, then the next one. So each time you pay off a credit card, now they've got $20 more, $40 more, $80 more, and it keeps growing and growing. But their total outlay per month, I believe when we looked at it, was like $3,700 a month. So that's all they're really doing is committing to keeping that total debt at $3,700. And as they wipe out credit cards, they keep paying $3,700 against their existing debts. And they do that for 20
Got it.
years or 14 years, and now they've paid off everything. And at the same time, all the money that's stuck in there kept growing and growing and growing, and they've got that as an ongoing savings account.
Wow. Okay, cool. Thank you. I'll email you.
Okay. And thank you for
Cool.
acting
Thank
as a
you.
guinea pig, and everybody else, thanks for letting it run a little long because we had so many credit cards. But that's just the risk you run when you do something live. All right. Well, I think that's it. Thank you, folks.